Hold on. You have a choice. You can have the boat or the mystery box.
What, are you crazy? We'll take the boat.
Oh, no, not so fast, Lois. A boat's a boat, but the mystery box could be anything. It could even be a boat. You know how much we've wanted one of those.
Then let's just...
We'll take the box.
We'll take the box. You gave up a boat for free tickets to a crappy comedy club.
I just love that skit. You know, basically what I'm getting at here is a lot of new investors and young investors, I feel, are choosing the mystery box way of investing. Basically taking on high risk versus choosing the boat, which is basically a guarantee. They're handing you a boat, right? They're handing you the guarantee that you're going to make money. And by doing this, you're investing in quality investments. And I think this is something that is just more heavily amongst the new and young investors because of social media presence. It's easy to go on YouTube, Reddit, Facebook, anywhere and buy into hype. These investors are buying into hype instead of quality. So they're buying into, SPACs, specs, new unknown crypto, penny stocks, all these things that they think can make them a lot of money, but instead they're risking their future and they're most likely going to lose money. And so what I'm going to do today is I'm going to go over the mystery box versus boat way of investing. And we're going to go over 6 topics. And at the end of this, I hope to show you if you follow these 6 rules, these 6 topics, you're pretty much guaranteed a big future wealth and growth in your money. You're going to have a very comfortable retirement. And so let's get started on all these. So mystery box versus boat number 1. We are going to be talking about trying to time the market. Now I want to show you this quick video with Ray Dalio talking about timing the market.
Ray, in terms of just bottom lining it, for those in the audience this morning that beyond thinking about buying your book are thinking about whether they should be invested in the market, putting more money in the market, and I'm thinking about equities right now, taking money out of the market, how do you value this market today?
I think that just the way you said it is going to be a fool's journey. To say, here's the stock market, and I'm going to time the movement into the market. I'm going to time the movement out of the market. Okay, you know what that means? Okay, you're going to guess what the next variant move is and what the next other thing is. A lot of things depend on a lot of other things, and the world and everything readjusts. What has to happen, I think, is investors, most importantly, have to realize 2 things. First, that cash is not a safe investment, is not a safe place, because it will be taxed by inflation. There will not be an interest rate that will anywhere near compensate. And it seems good because it's not volatile, but you're paying a tax of a few % a year on that. So A, stay out of that. And then B, know how to balance a portfolio.
It's a fool's game. Trying to time the market is a fool's game. It's the best way to lose money. I know so many people out there that try to time the market and they end up losing money. Either because they think there's going to be a stock market crash, so they sell out and then the market goes up. Hello, the pandemic, that March low. I had so many friends sell out of the market because they knew it was going to go lower. They just knew it. That's what they heard everywhere, right? All the hype. But then the market just went up, up, up from there, and they missed out on all those gains. And the thing is, nobody can predict the future. It's impossible. Look at Zillow with their recent mess with their trying to predict housing prices 6 months down the road. They couldn't even do that. And so how are you going to predict this new variant and what it's going to do, or anything else for that matter? It's impossible, and trying to time the market is one of the best ways to guarantee loss of money. And he also talks about cash. So right now, the inflation rate is at 6.2%. So that means the cost of, everything as a whole is going up at 6.2% annually. If you put your money in a savings account right now, you're making anywhere from 0.01 to maybe 0.5% at the most in some of those high yield savings accounts. So you're basically losing 5.7% of your money every year. Now, what helps out against that? Let's look at the stock market. On average, the stock market grows 10% a year. So right there, you're beating inflation. And this is a big, point to make is investing has, over its history, it's gone up on average 10% per year. And why is that? Because these companies that you're investing in, they are working hard to grow your money, and that's not going to change. And that's why I have such high confidence in the stock market. Now, I do think, though, however, it is good to have 3 to 6 months worth of living expenses as a rainy day fund. But outside of that, I don't recommend, hoarding cash in any way. Invest it. Find a way to invest it, whether it's the stock market or property or something like that. So the mystery box is trying to time the market, and the boat is not trying to time the market. Now, mystery box versus boat number two. Now, this is FOMO, fear of missing out. I think this is one of your worst enemies because by the time this fear of missing out sets in, a certain stock has gone up really high and you see that all these people made money. So it's starting to hit social media and the news, and you're like, oh man, I don't want to miss out on gains. So you buy in at the peak, basically, right? You're buying into this hype train, and the train's at the top of the mountain at this point. And so it's usually not the best time to buy in. So with FOMO, I think this represents people that aren't doing their research, right? They're just letting other people doing their thinking for them. You need to do your research because if you did, you probably would have bought in a lot sooner at that point. Or you'd realize like, hey, this is probably not the best time to buy in. Because usually when it comes to the point of FOMO, you have to, so the mystery box is FOMO and the boat is control. Be able to have control. So if you find yourself experiencing FOMO, realize it might not be the best time to buy into that stock. That might not always be the situation, but that's most likely how it's going to go. So that is mystery versus boat number two. So mystery versus boat number three. Now, I just love this quote. We're going to be talking about having patience. Now, Warren Buffett says the stock market is a device for transferring money from the impatient to the patient. This is a fantastic way of putting it. Those that have patience, it pays off big, and those who don't, they end up losing money. And who do they give it to? Those that are patient. So, you know, I see a lot of people, they have these high convictions on these stocks. They did their research, they buy into a stock, and then it has a little dip, and they're impatient, so they sell out. And then someone else comes and grabs up those shares, right? And then what happens? The stock goes up because it was a quality stock that you invested in. You just had you were impatient and sold out on a slight dip. Now, let's look at Microsoft, okay? Over the last 5 years, Microsoft has grown 421%. Now, 5 years ago, if you listen, in fact, it's pretty much the whole history of Microsoft. It's always been overvalued. That's how the media and the market what they always say about Microsoft. It's always been overvalued, and it probably always will be. Why? Because it's a high quality stock. So if you bought Microsoft 5 years ago and it had a small dip and you chose to sell out, and look it, you missed out on 421% growth in your money because you were impatient. And so it pays to be patient. It really does. So the mystery box is being impatient and the boat is being patient. So let's look at mystery box versus boat number 4. And that's going to be consistency. All right. So the mystery box is being inconsistent and the boat is being consistent. And what I mean here is on average, the, the market grows 10% a year. And the best way to guarantee you get that 10% is to buy as often as you can. Keep it consistent. I buy every paycheck. I think the more often you buy, the better. And, some people like to say, well, I'd rather hold my money till there's a dip. All right, here's the problem with that. First of all, you can't time the market, right? But, most people will say, I'm going to wait till there's a dip. So let's say the market goes up 40%, and you were here at the beginning, it went up 40%, has a 10% dip, and you buy and you're like, oh, I bought the dip. I'm so happy I bought the dip. You missed out on 30% growth because it grew 40%, dipped 10, and you bought in at the low of that 10%. But over that 40% growth, you missed out on 30%. So consistency is the best way to help the guarantee of growing your money at the average of the market, which is 10% a year. Or else you're going to miss out, right? Because some people that are inconsistent will get out of the market because for one reason or another, they're lazy, they forget about it, so they'll be out for a month, a year or two, and they miss out on that growth. And so being consistent is a good way to help grow your money. So mystery box is being inconsistent and the boat is being consistent. Now, mystery box versus boat number 5 is buying quality stocks. And there's a really awesome Warren Buffett quote that I love. There's actually two of them. One here is buy a stock the way you would buy a house. Understand and like it such that you'd be content to own it in the absence of any market. He also has a quote that says, if the market shut down for 10 years, he'd be totally fine with that. So, what does he mean by these two quotes? Basically, if you buy quality companies, so he bought into quality companies. He's saying if the market shut down for 10 years, he'd be okay with that because he bought into quality companies that he has a pretty high conviction they'll be around in 10 years, and not only be around in 10 years, but have really increased their profits, their revenue, their growth, their moat, all that good stuff. So when he gets back in 10 years, when the market opens up, his stock prices will probably be astronomically higher than where they were. And that's the thing. Can you say about the companies that you buy that they'll be around in 10 years and that they'll be much higher than they are today? If you cannot, you need to rethink those stocks and adjust for them. And that's what quality consists of, is buying those quality companies that you know have a future. And so, I like to look at things like increasing revenue, low debt, unless if they have some high debt, but that's because they're making a big move that should really help propel them. If they have a large moat, if they're buying back shares, if they have good future prospects, all these things are good. Look at the history, focus heavily on the future, and look at their quality. And by doing this, you're going to pretty much guarantee yourself growth in your money. Now let's look at the S&P 500. Now since basically the 19 looks like maybe 1980, let's say it went back to, the S&P 500 has grown 3,532%. That is amazing. And what is the S&P 500? It consists of the 500 largest companies. And in order to make it as one of the 500 largest companies, you have to be of quality, right? So that's what this means. Is buying quality companies pretty much guarantees you growth. And a lot of people don't focus on that quality. They focus on that mystery box, right? Oh, this is a new company with no history, really don't know what they're doing, but Reddit is saying this thing's going to grow. Why not focus on quality like Microsoft or Apple or one of those companies that is going to be much larger in the future than it is today? So the mystery box is not focusing on quality, and the boat is focusing on quality, and it pays off big, trust me. So lastly, mystery box versus boat number 6 is diversification. Now, I love this quote. It says, the beauty of diversification is it's about as close as you can get to a free lunch in investing. Now, what does that mean? That means that when you diversify, you're protecting your money. You're reducing your risk. You're pretty much guaranteeing the growth of your money, that free lunch. Diversification to me is basically buying insurance for your portfolio. And why would you not want to protect your money? And diversification is the best way to do that. A lot of people you're going to hear out there, put down investing in ETFs or having a diverse portfolio because they think they know it all and that they can pick, 5 stocks and they're going to make it big. Just watch what happens over time with those, okay? Trust me. Diversification is a great way to protect your money. And so the mystery box is not being diversified and the boat is being diversified. So let's cover these 6 again, okay? These mystery boxes versus boats. So don't try to time the market. Don't buy into FOMO, fear of missing out. Have patience. It really does pay off. Be consistent. Invest in quality companies and be diversified in your portfolio. If you do the mystery box way of investing with all these, you're pretty much guaranteeing that you're going to lose money because it's basically gambling. But if you choose the boat side of things, you're basically guaranteeing yourself growth and wealth for your future. Now, a lot of people like to say YOLO, right? Oh, you only live once. I'm going to invest all my money in this penny stock because I think it's going to go big. Well, good luck. You're going to probably lose your money. You're not going to have a good financial future. I like to look at it more as YOLO, as in you only live once, because I only live once. So I want to have wealth in this one life that I'm given. And so that's how I look at YOLO. And I hope these 6 things really help put things in perspective to you. Really think about them, right? This isn't, you know, me trying to say like you can't have a little bit of risk in your portfolio. It's just saying, why would you want to take risk with the majority of your portfolio? Why would you not want to guarantee yourself wealth and a good financial future? And so, um, just be careful out there. I think a lot of people that get into the market and that are new to it and young, they buy into the hype train. Don't buy into that hype train. I know it's not sexy to invest probably the way that I do, right? Consistent, quality stocks, et cetera, all the things we went over. But I'm guaranteeing myself wealth in the future. And you can too. And so let me know what you think of this video. Do you follow all 6 of these? Do you follow a few of these? If you don't, why? I'd love to hear it. So you guys have a great day, and we'll see you next time on Mark's Finance and Fitness.